Hi, this is Nate Williams from Practice Financial Group. Some of you may recognize my voice from the podcast Just Say No to the DSO, where I, with my podcast partner, Bob Spiel, try to persuade you to not sell your practice to a DSO. I believe that the production and the value of dental practices is because of the dentist. It takes a dentist trained mind and hands in order to produce anything. And so I believe that you should own the work of your hands. That's my bias. Why am I doing this? Because I also know that doctors are getting ripped off. They're getting swindled out of their practices, and this is a big heist that's happening. I've made the comment several times that the massive sale from private practice owners to DSOs is one of the largest wealth transfers, voluntary wealth transfers that we've seen in American business history. And this is true. Today, I've got an actual LOI and I've got my fancy spreadsheet to analyze this particular offer. And I'm going to walk you through the LOI and I'm going to walk you through my analysis of this practice. I did some of this verbally on my podcast and people said, hey, this is really helpful, but I'm going to go through in depth in case you're interested to see the behind the scenes analysis of what a DSO offer looks like. I want to emphasize that this doctor, which was actually a 2-doctor practice, they had shopped their practice to multiple DSOs, and this was the best offer that they could get. Okay. And I want to also say that one of the doctors was nearing retirement. He was about 5 years out, and so he was very much pushing to sell. And the other doctor still had about 20 years that he expected to practice. And so he was a little more reluctant, but also had heard it was such a good idea and was getting really pressured from his partner, from the private equity DSO guy, and from his endodontist friend who was getting a commission to sell the practice. He was also really pressuring them to sell and to join the DSO. I'm going to talk about that commission here in a minute. Now, let's get into the LOI. So they start off with a bunch of salesmanship. This is exciting given the alignment of practice philosophies and strong reputations for clinical quality. Now, the DSO is not a dentist, and it's not a dental practice. It's a behind-the-scenes ownership entity. What is their practice philosophy, and what clinical quality do they provide? I don't know. That's just salesmanship that you can expect from these offers. The DSO goes on to say in the LOI that they're going to provide exceptional back office support and administrative services. Yes, if you sell your practice to a DSO, this is exactly what they're going to offer to you. They're going to pay you some money up front, all of which you'll pay back to them in the form of now they own the profits. But this is the actual services they're going to provide: back office support and administrative services. So this is back office accounting and tax services. This is back office HR support, back office marketing. All of these things that they're going to do, you can get these out on the street. There are a lot of good dental CPA firms that provide back office accounting services. There are some really good back office HR firms like HR for Health, Bent Erickson. These guys provide back office HR services that are really valuable. And there's a lot of marketing companies that can help you market your practice if you need to do that. I would say that the market value, the street value of these services is about $50,000 a year, all of these things combined, all in. And that's a generous bill. If you sell to the DSO, they'll generally provide these services, and they'll charge you a management fee that's usually about 5%. So this practice, which has a $3.65 million revenue, the DSO will charge about $182,500 for these services. That's very common. And so they're charging $182,000 for what the street sells for about $50,000 all in. So pretty good deal for the DSO. So moving on, this practice, yes, I verified the tax return, $3.65 million of collections, and this of course is rounded, with an EBITDA of $1.138 million. Now, right off the bat, with the EBITDA, this is, if once you sell, that is what goes to the owner. The owner of the practice controls the practice and gets to keep the EBITDA. Okay. So over 5 years, and this of course comes with a 5-year contract, these doctors will pay, these doctors will pay the DSO $5,690,000 just in EBITDA to them. So the minute they sell, the clock starts ticking. Here, you get the EBITDA over the 5 years. That's what it's worth. I automatically know that you can subtract this from the purchase price, and that's what you're actually getting. So they say they're going to sell it for a total enterprise value of $9.2 million. And there's going to be $5.1 million of cash in closing. They do say they're going to hold back $425,000, and it will be paid in 12 months post-closing, subject to stuff, okay? They're also going to get $700,000 of earnout, $850,000 promissory note, and $2.55 million of rollover DSO equity, whatever that's worth. There's no way for you to actually quantify what this is worth. You just have to take their word for it that it's worth $2.55 million, but I have no idea what this is actually worth. Okay, so this is the total price. So just so you know, in my analysis, I assumed that they don't get the $700,000 earnout because down here, there's this table of how much money they have to collect. And I assumed that the collections were actually less than this, so that I'm counting that they're not going to get this earnout bonus, but they're not going to get these collections either, okay? Moving on, and I'll go over this analysis on my spreadsheet here in just a minute. Moving on, they say that this DSO believes that the owners should be rewarded for their assistance in closing these partnerships and in recruitment efforts. This is one of the smartest things the DSO has done. If your name is Dr. Fill in the blank, you have to know that you're like a financial trophy buck walking through the forest. Everybody knows and expects that you have money. And so you are hunted by people who want your money incessantly. You know this already, right? Now, the thing that doctors do is they're very distrusting, just like a skittish elk. And but generally, doctors have been able to trust each other. You've been able to trust your colleagues, generally speaking. That's why places like Dentaltown have been historically popular, and Facebook groups have been popular because it's for us, by us. We're just talking to ourselves, and all the vendors, we can shut them up and shut them out. But now the DSOs, and again, this is the smartest thing they've done, they've turned the dentists into their sales force. So they should be rewarded. And Exhibit A explains this. So if you go down to Exhibit A, just black and white, they get 3% of the target practice prior 12 months of revenue. So this practice, which did $3,650,000 times 0.03, this is a $109,500 commission for the endodontist friend who is persuading them to sell. When I told him this, the doctor who owns the practice, when I told him this, he was really somber and kind of quiet. And he told me that they were initially going to back out. And then one of the DSO guys flew into town and took him and his partner out to dinner. And the endodontist came, and they both just gave him a whole dinner's worth, and with wine, of course, sales pitch on how this is so wonderful. And they actually had there at the dinner a contract for them to sign to sell and to close the practice. They luckily didn't sign it, but they were very tempted to. And in a last-ditch effort, this guy reached out to me. And we had this conversation that I'm now having with you. Going back up to the rest of the practice. But I just want to table this. The endodontist, the $109,000 commission, the endodontist trying to persuade their friends to sell. Let's see if that endodontist was giving good advice. I'll let you make the call for that. They go on to say that you'll be W-2 employees of the practice. So right there, eliminate any of the tax benefits of being a business owner. So the retirement benefits that you can deduct, your auto expenses, your cell phone, meals and entertainment, travel expenses, all of that stuff gone as far as the tax perks. Check this out. this offer had a 20-mile radius non-compete. So a 5-year non-compete, 20-mile radius. And then in addition, and I applaud the DSO for disclosing this right here, but in addition, they were going to have, as part of their employment contract, that the non-compete, the 20-mile radius non-compete would apply for 2 years post-employment. So if they worked for the DSO for 5 years and then quit, they would have to wait 2 whole years to set up shop or to join a practice, anything else within this 20-mile-an-hour radius. When I explained this to the doctor, he said, I would have to move and completely start over. And yeah, that's exactly right. If they were to sell this practice, and let's say it didn't go well with the DSO now has all the control. In order for them to get out, they would literally have to move and completely start over, start from scratch in the middle of his career. Horrible, horrible, horrible decision. The DSO goes on to say, we expect that you, the owners, will continue to lead the practice going forward. So a lot of doctors want to sell to a DSO because they think they're going to get this huge alleviation of the burden of running the practice. This is saying you're not going to get that burden. Yeah, we're going to provide some of the back office stuff, some of the stuff that you can outsource to a dental CPA firm or to a marketing company or to an HR company. We're going to do that stuff. But all of the hard work, the meeting with the employees, the day-to-day management and running the practice, that's going to fall to you guys. You're going to have to keep up that work. That's where the real work is. And so if you think that you're going to sell to a DSO and then it's just going to be easy after that, not true. If you think it, you're kind of a fool. They say here that we want an expedited timetable. Yeah, we want to sign this right now if you're the DSO. Exclusivity clause. So once they enter into this deal, they will no longer be able to talk to any other DSO. Okay, let's take any competition off the table. That's what the DSO wants. So that's the rest of it is just kind of common legalese, stuff you'd expect out of an LOI. But let's get into the numbers, right? Let's get to the nitty gritty, what we all came here for. So here's the cash at closing. And the cash at closing is the 5.1 million minus the 425,000. So that's what they're going to get up front. Then they're going to get 425,000 earnout. But I assume that they didn't hit this $700,000 carrot bonus. And why? Is because I ran the numbers on a 3% increase, and the DSO wants them to actually grow faster than 3%. So I just assumed you're probably not going to hit that. But if you do hit that, or if you would have hit that, then they would get an extra 700,000 here, but they would also get the extra collections here. So I'm going to do the analysis without the $700,000 carrot, and then you, in your own judgment of my analysis, see if that $700,000 actually makes any difference over as far as the analysis goes. So here's the cash at closing, 467,000 minus capital gains taxes. So I allocated 80% of the purchase price to long-term capital gains, which is the favorable tax rate. And then I allocated 20% of the purchase price to ordinary income, which is the not favorable tax rate. And so these are the total taxes they'll pay. The net cash at close, $3.438 million. That's an important number. Now, there are 2 doctors, so they would each get half of that, but consolidated, they would get the full number. Then over the next 5 years, they're going to get this $425,000 earnout, which is the 12-month carrot, like make sure this all goes down and goes good. 5 years of doctor compensation, right? And I calculated how much compensation they would get, which is this total amount plus, allocated to each doctor based on their production ratio. And this amount I got by summing the doctor comp. I'll go over this in a minute. So I think these numbers are good. Rental income, Dr. 2 owned the building. He was going to get an additional $120,000 a year or $600,000 over the 5-year rental income. So I'm going to add that to his pile. And then here's the total compensation. I'm going to charge taxes because there's no getting away from that. And so here's the net comp, net of taxes over the 5 years. So the total after-tax compensation from selling the practice in the first 5 years, $8.6 million, or 4.3 to this guy and almost 4.3 to this guy. This guy's the higher producer. This guy owns the building. So that's the analysis, okay? That's what they get if they sell. Now, if they don't sell, they get the revenue of the practice minus the fixed overhead, minus the variable overhead, which is 12% of the revenue, and that's what they get, okay? And the doctor compensation is 35% of the revenue multiplied by the doctor's production ratio. So in this particular practice, 9% was to hygiene. You can guess what specialty this is. But the owner doctor's compensation is the doctor compensation or associate pay plus the EBITDA of the practice, okay? So if they own the practice, they get the sum of these two things. If they sell the practice, they only get the doctor comp plus this up here. So then I had them running through $150,000 of perks. The reason that's important is because it's going to reduce their tax liability. Then they're going to pay taxes on the doctor comp plus the EBITDA minus the perks multiplied by the effective tax rate of 28%, I'm assuming, gives them a total owner compensation of $1.7 million after taxes is what they get per year after tax, okay? And then to get these different columns, I'm going down 20 years. One of the doctors said, I'm going to work for 20 years. I just assumed 3% inflation. So I adjusted the revenue, the fixed overhead, the variable, the doctor comp, and then the EBITDA is just the fallout, so what's left over. I adjusted these by 3% per year, okay? And you can take a screenshot and run the numbers yourself and check my math. Well, check the math of Excel. It's usually pretty accurate, Excel. So let's get to the summary. Let's get to what, just tell us the answer, okay? Here's one way to look at this. If they sell the practice, here's option 1, sell. Option 2, don't sell. If they sell, in 5 years, they have $396,000 less of cash. How did I get this? I got this by taking the $8.6 million total after-tax compensation that they get from selling minus the total after-tax compensation to the owners that they would have got if they retained ownership of the practice, okay? So it's the sum of the 5 years of owner comp that they would have gotten if they would have just kept owning the practice. And in this practice, they're actually worse off by almost $400,000 of cash if they sold. And so, but if they sell, they get this $2.55 million of DSO equity. Who knows what that's worth? But just after 5 years, and so a lot of you doctors are close to retirement, and you're thinking, I'm 5 years away from retirement. Because I'm about to retire anyways, and I'm not going to work for a long time, I'm going to sell to a DSO because maybe I'm better off doing that. At 5 years, they're $400,000 of cash worse off, but they get the DSO equity. So if you're the selling doctor and you're going to retire, or you think you're going to retire in 5 years, would you rather have your practice, maintain ownership of the practice, and you get $400,000 of cash more, plus at the end of 5 years, you still have 100% ownership of the practice that you can go out and sell, or you can keep it and work longer if your retirement plans don't work out? Would you rather have that, or would you rather have $400,000 less of cash plus the DSO equity? That's the question if you're going to retire in 5 years. I know what my answer would be. It would be I would much rather have ownership of the practice because I don't know for certain that I'm going to sell in 5 or retire in 5 years. I think I might retire in 5 years. But if the supposed I had $1 for every doctor who thought he was going to retire in 5 years and then didn't end up retiring in 5 years, I'd probably have a lot of dollars. What I'm saying is you don't know what you're going to do. You don't know where you're going to be, what you're going to want in 5 years. So to make this decision now, I think is kind of foolish. I would much rather retain the practice and retain 100% ownership of my practice rather than some fractional ownership of some DSO where I have no idea what I'm getting and what it's actually worth. This is a very important number as well. What if you don't sell the practice in 5 years? What is the cash gap of year 6? Well, the cash gap in year 6 is meaning if I own versus I don't own, the cash gap in year 6 is simply $1.3 million. And what is that number? That's simply the EBITDA in year 6 that you no longer get, right? So in year 1, you sold, you got a bunch of money up front. You paid that all back to them in the form of the EBITDA that you now give to them. But at year 6, now you're just an associate, only just getting the owner doctor pay and not getting the EBITDA, right? Well, what's that worth? $1.3 million. So that's how much worse off you are each year working in year 6 and beyond, okay? So to this, the doctor who is going to stay for 20 years, let's assume that both of them stayed for 20 years. The total compensation for just my doctor, so half of this was $32 million, which is the total doctor compensation, which is almost 62 million divided by 2, right? So $32 million was the total lifetime or the 20-year comp for this guy if he retained ownership. The EBITDA that he would give up in years 6 through 20, this is what he would have given to the DSO, worth $12 million. So one way to look at this analysis is for this guy, this would have been a $12 million mistake to sell this practice and to kiss goodbye his 50% of the EBITDA of $12 million, okay? But the analysis doesn't go there. Doesn't end there, I should say. I'm going to do a second analysis, which I'm going to call an investment analysis. So what a lot of pro DSO salesmen have been saying is that it's good to sell your practice because you're going to get a lump sum of money up front. Yep, that's true. You are. For these guys, $3.4 million. And then the DSO salesmen tell you that you can invest this money and that money will grow. And in 20 years, you'll have a bunch of money and it'll have a lot more and you'll be able to accelerate to retirement. I listened to a podcast recently by a really famous orthodontist who said, if you invest $3 million in 20 years, you're going to have $20 million. And I love that example because these guys had $3.4 million to invest. So let's go and look at the example. Okay. So here's the sell to a DSO, this DSO, you get 3.4 million and you invest that and you get a 10% investment return. 20 years later, that is going to balloon to $21 million. That is amazing. Yes, compound interest, time value of money is an amazing thing. You're going to get $21 million, okay? But what if you didn't sell to the DSO and you simply took the after-tax EBITDA that you would have earned and invested that? So every year, here's the EBITDA minus, and I even to give it, to benefit the DSO, I used a 37% tax rate on this EBITDA. So I'm not fudging these numbers at all. And I'm saying, okay, so here's your after-tax EBITDA, which if you're the owner, you get it. If you're not the owner, you don't get it, right? So if you sell and you're not the owner anymore, you get the 3.4, but if you retain ownership, you get the EBITDA. And so let's assume that these doctors were really disciplined and they invested their EBITDA. Where would they get to? Well, here's the total investment. Here's the cash invested per year, and here's the total amount, and it grows to a shocking $50 million. So this is a side-by-side comparison of if I would have invested all of my money up front versus if I would have invested the EBITDA year after year going forward. $50 million versus $21 million. So another way to say this is if these guys would have sold the practice to this DSO, it would have been a $29 million mistake. So now, with that as the backdrop, What do you have to say to the endodontist friend who was trying to persuade them to sell their practice? And he was going to get a $109,000 commission, but you were going to make a $29 million mistake. How good of a friend is that endodontist now? And what do you have to say to the DSO guys who are trying to persuade you to sell their practice? They're going to give you $4 million up front out of their own pocket, plus some promissory note stuff, plus some chumped up dilutable shares of their own equity, of their own entity. So they're going to give you some compensation, right? But the DSO is now going to control the practice. They're going to collect their management fee from the practice. And they're going to now have ownership and control of all of the EBITDA, which just the tax value is $30 million, or the cash value. So you can see from my analysis why. I hope I'm answering a lot of questions for you. Why do DSOs want to buy your practice? I hope I'm answering that for you. Why is dentistry attracting the attention of these private equity guys? Well, this is why. $30 million of EBITDA is why. And so, yeah, I hope this analysis has been helpful. And to you doctors who have sold your practices, I don't know what to tell you. You very likely made the worst financial decision of your life. To you doctors who are thinking of selling, all I have to say is just say no to the DSO. I've been trying to tell you this over and over and over in a nice and respectful and educational way. And to you who are trying to persuade doctors to sell their practices to your DSO, yeah, that's a lot of salesmanship. And I just wonder how you look in the mirror at night. I really wonder how you do that. Okay, I hope this is helpful. Hope you have a good rest of your day. Nate Williams signing out.